Hello? Hello?
Podcast Network Asia.
FirstMetroSec is providing this podcast as a general market commentary. Reference to any specific security, product, or entity do not constitute as an offer or a solicitation of an offer to buy or sell any financial instruments or to participate in any particular trading strategy. The statements, comments, views, or opinions expressed by the hosts are subject to change without notice, and FirstMetroSec is under no obligation to update, amend, change, or correct any of the statements, comments, views, or opinions expressed. The statements, comments, views, and opinions expressed by the guests are their own and do not necessarily reflect the view of FirstMetroSec. FirstMetroSec disclaims any liability arising from reliance on or reference to any information obtained in this podcast.
You are listening to First Metro Securities Philippine Stock Market Weekly podcast, where we feature timely and relevant discussions on the Philippine stock market and the economy in the hope of providing you investing and trading guidance. Here's your host.
Hello everyone. I'm Peter Garnace, an Equity Research Associate of First Metro Securities. In this episode, I will discuss our company update on RL Commercial REIT or RCR. We maintain our buy call on RCR with TP slightly cut to 5.64 pesos. We reiterate our constructive view on RCR in light of the following reasons. Firstly, the shock and awe approach to asset injections. Recall that management announced in April that it is planning to inject up to 25 billion pesos in assets into RCR. In the recent update on June 6, 2024, it is now apparent that management has upped the ante for asset infusion. We are of the view that this announcement will have a material impact on RCR's investability and dividend generation. First, the size of the planned asset injection is significant. Valued at 33.9 billion pesos, it amounts to over half of RCR's total asset base of 66 billion pesos and current market capitalization of 53 billion pesos. Post-infusion, RCR would be the largest Philippine REIT by asset size, totaling 97.8 billion pesos in value. We envisage this will enable RCR to leverage on a virtuous upcycle of growth and premium valuations, especially in view of its strong unlevered balance sheet. Second, we welcome that a more diversified source of rental income will allow for resilient dividend growth. Amid the current challenges in the Philippine office sector, we see the infusion of RLC small assets to support rental revenue growth. Finally, the shift away from a pure-play office REIT should improve RCR's long-term inorganic growth profile. Following the change in management's tones regarding their approach to asset infusion, finally, the shift away from a pure-play office REIT should improve RCR's long-term inorganic growth profile. Following the change in management's tone regarding their approach to asset infusions, RCR can now access the sponsor's breadth of real estate assets such as malls, hotels, and warehouses. There's much headroom for growth as its sponsor RLC still has over 244,000 square meters of office gross leasable assets, 1.3 million of mall GLA, 26 hotel properties, and 244,000 square meters of industrial facilities in its portfolio. Secondly, RCR's current trading yield is attractive at 7.6% and 7.8% for 2024 and 2025 dividends per unit respectively. Without factoring any of the above-mentioned plans by management, we acknowledge that our DPU forecasts assume slow growth of 1% and 2.5% for 2024 and 2025 respectively. We attribute this to the challenges in the Philippines commercial real estate sector. Nevertheless, we think that the latter is already in the price given the ample spread of 90 bips versus local 10-year bond yield. Thirdly, we think bond yields may have already peaked. On one hand, we highlight the slowing economic growth as evidenced in the first quarter GDP report card. On the other, inflation relief is underway following the reduction on price tariff to 15% from 35% previously. Thus, we see receding upward pressure on bond yields as a catalyst for the outperformance of yield-sensitive counters such as REITs. we remind our listeners that Philippine REIT yields are strongly correlated to the Philippine 10-year bond yield. For RCR, it has a strong positive correlation of 71% since listing. We continue to like RCR with a target price of 5.64 pesos. Our new TP implies a dividend yield of 7 and 7.2% on 2024 and 2025 payout respectively. It is derived from DCF valuation methodology with WACC at 10.7% and terminal growth at 3%. We have yet to factor in any asset infusion in our valuation and dividend estimates. Our back-of-the-envelope target price based on the recently announced property for share swap transaction is in the range of 5.70 to 6.30 pesos per share. This assumes an acquisition yield of 6 to 8.5% and a target dividend yield of 7%. And that's it for our RCR company update. Thank you.
Thanks for listening to First Metro Securities Philippine Stock Market Weekly podcast. Don't forget to follow us to get first dibs on our new episodes. For more up-to-date market news and info, exclusive content, and the opportunity to connect with your fellow Filipino investors and traders, join facebook.com/groups/FirstMetroSec and be part of the FirstMetroSec family.
The views and opinions expressed by the podcast creators, hosts, and guests do not necessarily reflect the official policy and position of Podcast Network Asia, the hosts of the program, or other programs of the network. Any content provided by the people on the podcast are of their own opinion and are not intended to malign any religion, ethnic group, club, organization, company, individual, or anyone or anything.